You may not even recall after a terrible day like today, but the year did get off with a bang, with a huge rally in the first couple of weeks. But now that earnings season is upon us, we're pulling back hard. You never want to come into earnings season too hot because it sets the stage for disappointment, even if the underlying numbers are good. And regular viewers know I do have some reservations about this earnings season in particular. You know, I don't like tech. But really what we're seeing here is a pivot toward a market that's driven more by the action in individual stocks than by the big picture economic data that drives the Federal Reserve. We're getting a brief Fed reprieve here, at least until we get closer to the next meeting at the end of the month. Although today's decline shows that when you get softer data, it may keep the Fed from tightening too much, but it also provides evidence that the economy might have a hard landing. That was a big thesis for today, and we got to avoid that at all costs. Now, this is a bad news is good news market still because of the Fed, but if it gets bad enough, as people thought it was today, and I don't know we're there yet, well, let's just say you get a lot of days like today. I don't think we're there yet. For now, what matters are individual earnings reports and conference calls. But those are all over the place. And more important, it's hard to tell which reports Wall Street will take its cue from. I mean, we had a great example yesterday. We spent a lot of time on it. We got a terrific set of numbers from Morgan Stanley, but it was paired with an awful set of numbers from Goldman Sachs. I don't know about you, but I just thought all anyone cared about was Goldman. Given that the market came into earnings season pretty overbought, the negative Nancy's won the day. I have to tell you, my Charitable Trust owns this Morgan Stanley. Wow, it was a great quarter. So right now we need a better sense of which way the market might lean over the course of not just this week, but the whole of earnings season. That's why tonight we're going off the charts with the help of Jessica Inskip. She's a brilliant technician. She was the first woman on the active trader desk at Fidelity before becoming the director of advanced trader strategy at Merrill Self-Direct. Now she's the director of product and education at Options Play. But she still consults with all the major brokerage firms in the self-directed space. Plus, you can see her every Tuesday on Fidelity's weekly options trading show. It's called In the Money. Remember, back in early December, Inskip warned us that the market might be in for a bumpy ride about a week before the big mid-December sell-off. She nailed it, which is why I wanted to bring her back on for today. What does she see now? All right, take a look at the daily chart of the S&P 500. Inskip points out that the earnings season is often a source of volatility. There's no coherent narrative. So you tend to get a lot of strong rallies and strong declines while trading all around. Now, the S&P 500 has been stuck in a downtrend for over a year at this point. No kidding, huh? You can see the downtrend line's been acting as a ceiling of resistance, really remarkable, for this market ever since the Fed declared its crusade against inflation back in November of 2021. We've never really been able to break through this incredible ceiling. Titanium, even though there have been occasional bounces that took us pretty close. Almost. Inskip notes that when you look at the last two earnings cycles, they all led to pretty powerful rallies, as the numbers came in better than feared thanks to a resilient consumer. So you see this, and then you see this, okay? But both of these runs came to a halt below the downtrend line that I just mentioned, as Wall Street started worrying about the Fed again. The market could only be so good when we knew Jay Powell was going to keep bringing the pain. This time might be different, though, because Inskip says we're not in the same setup as we were here. We're here. Look where we were when the second and third quarter earnings season started. The S&P was very close to the low end of the trading range. We were in the valley of despair. Then earnings season got a little rocky before eventually propelling us higher. This time, though, Inskip points out that when fourth quarter earnings season got rolling, the S&P 500 was already right below the ceiling of resistance created by that downtrend line. While we pulled back over the last couple of days, of a few important quarters come in stronger than expected, Inskip could see the S&P potentially breaking out to the upside because it's so close right now. It's a whole new ballgame. Is it likely? How about this? The Jaguars, they came back from 27-0 against the Chargers when they shouldn't even been in the playoffs. Maybe it's safe to expect the unexpected. Plus, the S&P is currently well above its 50-day moving average. The 50-day is the red. We see that. It's well above it right here, even after today, which has been trending higher for nearly 2 months. For charters, that's a pretty encouraging sign. And even if things turn ugly, like we have more days like today, Inskip notes we got a floor of support formed by the market's bottom in October, okay, right here, where it stabilized late last month. This is the floor that propped us up when the market got clobbered in mid-December, a floor that turned into a springboard for the early January rally. Okay, now let's remove some of the noise and check out the S&P weekly chart. Now, first I want to look at the moving average convergence divergence, or MACD line right down here. This is what we're going to focus on for a moment. Remember, that's an important momentum indicator that can help predict changes in the trajectory of the market ahead of time. Ever since the MACD fired off a buy signal in October, so let's jump to here, where the dark line crossed above the light line, we've had a terrific run. Inskip points out that we're looking at what's known as a bullish divergence here. Even when the S&P makes new lows, the MACD keeps making higher highs. MACD pretty good here, right? Versus what you've seen all the way around here. You know, and that's a generally positive sign. But, in this big but, there are some negatives here, too. The S&P is running up against that ceiling of resistance created by the 50-week moving average. But don't like to see that. You know, you can see that we are just not, nothing's perfect. The indicator that many are looking at. Then there's this thing called the Ichimoku cloud. You see these green and red lines? A lot of my friends who are technicians like this thing. They're part of a technical tool that combines a host of moving averages to give you an at-a-glance read of the situation. Right now, it's still red. No, not a good situation. It's also above us, acting as another ceiling of resistance. In short, Inskip thinks we need a catalyst to break through this level and turn things around. Without a positive catalyst, she's not feeling sanguine. But this is earnings season where catalysts abound. Finally, we need to talk about the area I don't like, tech. Because bear markets rallies tend to be led by the worst performing sector, tech, and lagged by the best performing sector, in this case, energy. Most of the techs and the energy companies report next week and the week after, and the two busiest weeks of the earnings season. So take a gander at what's known as the XLK. That's the Technology Select Sector Spider ETF. Real mouthful there. According to Inskip, if we want to have a rally, to have legs in this environment, we need tech. Right now, the XLK is just under 130 and is looking at the 50-week moving average. Okay, so it's kind of pretty low. Before it hits the first ceiling of resistance, with the Ichimoku cloud giving us another ceiling above that. Remember, that's the at-a-glance technical tool I mentioned earlier. So there's still some room for tech to lead us higher here, even after the staggering runs over the past couple of weeks. Remember, we did have 7 straight days of NASDAQ go up before today. But in the end, we need better than feared earnings before we can get a breakout. And I told you, I don't think we're going to get them. Here's the bottom line. The charts interpreted by Jessica Inskip suggest that we're all at a very important moment where the S&P 500 found an equilibrium between the floor of support and a ceiling of resistance. At this point, something has to give. And that means this earnings season could be proved to be especially decisive. Good numbers could give us more upside than we've seen from the last few quarters, but bad ones might mean the S&P heads right back down to the low end of the range. And it looks like, even as I disagree, there's no in between. Let's take phone calls. Let's go to Sonny in Illinois. Sonny.
Jimmy Chill, a big Chicago, Windy City booyah to you, my friends.
Benny's Liquor booyah back at you, if you don't mind.
My favorite place. Hey, listen, I wanted to take the time and thank you for educating and entertaining us little investors.
Well, you know, first, I just say you're not little. I mean, that's the kind of stuff that I got to discourage. We're all the same size. Just some of them got bigger mouths, you know?
We're little compared to your buddies at Goldman, you know?
Yeah, I left only the buddies. I mean, I know Solomon. I could probably name 3 people at Goldman. There's like 40,000. Hey, there were 973 people at Goldman when I left. Pretty interesting, huh?
Wow.
So go ahead.
Yeah,
let's go to work.
Well, listen, I wanted to talk to you about a company that's been saving lives for the past couple of years during the pandemic. A couple of analysts have downgraded Pfizer recently. Is now the time to build a position, or should I wait for a couple more analysts to downgrade and possibly get it even cheaper?
Okay, I think that you're getting it cheap right here. I listened to Dr. Borla be interviewed by Sarah Eisen this morning around 5 a.m. our time, and I felt he had a lot of great things to say. Now, it does yield 3.6. It's yielded 4 times. I buy some here, and then I buy some if it yields 4 again, because this is a good story. And Borla talked about something almost like 20 new compounds coming. I thought it sounded very exciting. I was going to say let's buy it for my charitable trust, but boy, we got a lot of drug stocks. Anyway, thank you for those comments, though. The charts interpreted by Jessica Inskip suggests that we're at an important moment, crucial moment, The S&P 500 has found an equilibrium between its floor of support and its ceiling of resistance. That means this earnings season is one to watch. The results could prove to be decisive. I think it's decisive for some and not others. Much more Mad Money ahead. Does J.B. Hunt have what it takes to help your portfolio cruise higher after earnings, or is it a learning lesson, or both? I'm running through the company's quarterly report. And COVID changed our lives as we know it. But as we emerge from the depths of the pandemic, how should it change your investment strategy? Maybe you just look around and see. And all your calls rapid fire in tonight's edition of the Lightning Round. So stay with Cramer.